All right, here we go. Direct write-off method. Apply the direct write-off method to accounts receivable. When a company, when a company directly grants credit to customers, it expects some customers will not pay what they promised. The accounts of these customers are uncollectible accounts or bad debts. Uncollectible accounts are an expense of selling on credit. Why do companies sell on credit if they expect uncollectible accounts? The answer is that companies believe that granting credit will increase total sales enough to offset bad debts. Companies use two methods for uncollectible accounts. One, direct write-off method, and two, allowance method, recording and writing off bad debts. The direct write-off method records the loss from an uncollectible account receivable when it is determined to be uncollectible. No attempt is made to predict bad debts expense. If TechCom determines on January 23rd that it cannot collect $520 owed by its customer J. Kent, it records the loss as follows. The debit in this entry charges the uncollectible amount directly to the current period's bad debts expense account. The credit removes its balance from the accounts receivable account. So for January 23rd, we would have a $520 debit to bad debts expense and a $520 credit to accounts receivable. Recovering a bad debt. Sometimes an account written off is later collected. If the account of J. Kent that was written off directly to bad debts expense is later collected in full, then we record two entries. On March 11th, for example date, say that's when they happen to actually pay up. On March 11th, accounts receivable for J. Kent was debited $520. Bad debts expense is credited $520 to reinstate the account previously written off. And then on March 11th, cash is debited $520 while accounts receivable for J. Kent is credited for $520 to record the full payment of account. Using the direct write-off method. Many publicly traded companies and thousands of privately held companies use the direct write-off method. They include Rand Medical Billing, Gateway Distributors, First Industrial Realty, New Frontier Energy, Global Link, and Subsurface Waste Management. The following disclosure by Pharma BioServe is the usual justification. Bad debts are mainly accounted for using the direct write-off method. This method approximates that of the allowance method. The direct write-off method advantages include that it's simple and no estimates are needed. And disadvantages of the direct write-off method is that receivables and income are temporarily overstated and that bad debts expense often is not matched with sales. Companies weigh at least two concepts when considering the use of the direct write-off method. One, expense recognition, which requires expenses to be reported in the same period as the sales they help produce. And two, materiality constraint, GAAP or GAAP, generally accepted accounting principles, permits the use of the simple, low-cost direct write-off method when its results approximate those using the allowance method. Need to know. Two. All right, we can skip past this. Oh, crap. This is the end of it. All right, never mind. So just for an example here, a retailer uses the direct write-off method. Record the following transactions. On February 14th, Valentine's Day. On February 14th, the retailer determines that it cannot collect $400 of its accounts receivable from a customer named ZZZ Company. April 1st, April Fool's Day. It's like, just kidding. We're able to pay. ZZZ Company unexpectedly pays its account in full to the retailer, which then records its recovery of this bad debt. I wonder if those dates were chosen intentionally. Solution. On February 14th, Love Day, Valentine's Day, the bad debts expense is debited for $400. Accounts receivable for ZZZ Co. is credited for $400 to write off an account. On April 1st, accounts receivable ZZZ Company is debited for $400, while bad debts expense is credited for $400 to reinstate an account previously written off. And then on April 1st, the cash, the same day. So this is the one with four transactions or four different things. April 1st, cash. Cash is debited for $400, while accounts receivable for ZZZ Co. is credited for $400 to record the cash received on credit. Bingo, bango. I'm gonna drink some mango. God, mango juice is good. Woo! All right. So that was direct write-off method. Solid. I'm gonna eat some lunch.